We want to start off really thinking about what is really happening. So there's a lot going on in the market right now. This is the lowest level we've ever seen investor confidence in energy companies. Dan, what do you say? How do we put statistics around this?
Well, I think if you look at the kind of the long-term secular shift, right? So energy as a percent of the S&P is now less than 5%. It's been trending down kind of 15% at the peak in 2008. And even going back in the prior decades, like kind of the 80s, 90s, it was 25% of the S&P. So we've seen this long-term kind of secular trend out of energy. And now you see today, I think, for much more different reasons, right? Usually the story is, do we have too much oil, not enough oil? And that's been the kind of the drivers of the cycles. Here we are today, I think it's much more of a demand story. Is the demand going to be there in the future? So when we look at the current shift, it's a lot about these macro factors, right? So the energy transition, the decarbonization, and peak oil demand. So that's really where we're seeing the pressure put today, and kind of questions that we haven't had to answer in the past. So that kind of is the macro, kind of 50,000-foot view.
Is this just another cycle, though? I mean, we're used to the Dow dogs becoming the heroes in the future. Is that what's happening, or do you really think this is a fundamental shift? Maybe I'll switch over here and talk to a couple of other colleagues about that. Raul, what do you think? Is this a normal shift or something totally different in the world?
Well, I think it's different in the sense that this particular one is broadly energy, but specifically a lot of the E&P companies that are centered on North America and the shale revolution. And in a lot of ways, they have a business model which is devoted to growth, which has been extremely effective in growing. And that played very well in the 2000s when the world was considered resource scarce, resource short. In an era of abundance, which is what we're currently in, partly due to these shale players, in an era of abundance, having growth is not only not differentiating, but it is positively a pessimistic result, right? And so it's adding fuel to the fire in some degree when everybody says, well, I can continue to grow, right? So they're bringing something to the market that the market doesn't want. They're bringing sand to the beach in some ways. And I think that's making this a little bit different, in addition, of course, to the longer term perspective around energy transition.
So you got these companies that used to be growth players that now all of a sudden have to come up either with a hybrid story of value rather than growth, or both. Let's go over here and talk about the investors. Since when you spend a lot of time talking to investors, what's the message they're telling you about this?
Yeah, I think it echoes both of what you're talking about. There's a short-term concern about commodities price volatility, the historical track record of destructive capital allocation by some of these companies that have resulted in poor relative returns. But then when you put yourself in the shoes of a generalist investor who has access to the entire capital markets, who can access, relatively less controversial growth companies, why would they spend their time and attention on, the broader energy space, which, if you think about it long term, could almost be described as a sector in an existential crisis because of all the rhetoric around climate change and ESG investing these days. So I think it's a mix of both.
When you look a little broader, there's a lot of the news that actually all sort of managed funds are no longer doing as well as indexes. Can we say that maybe that's part of the problem too, or is the energy business truly unique in this sort of affliction that's going on right now?
Well, the trends of the rise in passive investing, I think, affect all sectors. And I think it's even more prominent when you think about the drop from 20% plus of the S&P 500 to now 5%. When it's that small as a part of the index, it really can get ignored by the passive funds. However, as an active stock picker, you do have this choice of where you're going to spend your time and where you're going to allocate your capital. And I think that is where there are some sector-specific nuances with energy that are deterring investors from adding capital to the space.
Yeah, and we see that in North America, actually. So, the work that Quinn's team does, we see the active investors, the value guys, the growth guys of exiting. We see a rise in the index investors. And that's the broader thing that you're talking about, Bob, where we see just in terms of the overall investment of moving away from active investors because of lack of outperformance to passive index funds. But that has a secondary effect, right? Because if you're Conoco, that's great because you're going to be in a lot of those indexes that are getting that capital. If you're a smaller North American E&P, you might not be in so many of those indexes. So there's that added burden of these smaller guys to get bigger, to increase their reserve size, their market size, so they can get more exposure to these index funds where some of this capital is getting rotated to.
So who the investors are is changing. So Reed, when you think about, then it sounds like we're sorting out these basins in a big way. What sort of company then is going to be attractive as for these investors if we have a smaller pool of money and they're looking at, as Dan just said, these index funds are still buying oil and gas companies, but
So when you think about the way the industry has changed, we saw massive growth over the last decade in supply, and it was driven by a lot of entrepreneurs, a lot of wildcatters, and the majors really stayed out of that. Certainly in a material way, they dabbled, but they stayed out of it. Now we're seeing them, as the industry has matured, the basins are de-risked, the upside is largely played out. That's when we see them come in, and why? Because these guys are good at managing projects. They're fine tying up $200 or $300 million in CapEx before they get production as we move to pad development. And so it's really going to be a sorting out of being able to build scale, but also we're seeing the independents, the U.S. independents, now having to compete in the marketplace against value-driven, dividend-paying companies, which is not the DNA of these independents. So the question is, can the guy who ran the 100-yard dash switch to be a marathon runner? We're seeing some companies do that, but we're also seeing, every week it seems there's an acquisition notice going out, whether it's almost a merger of equals or, the shark eating the minnow. They're all doing it to try to build scale so that they can compete on a metric they haven't historically been able to compete on. And that has huge implications for where we see U.S. supply going, where we see investment sentiment going, and the type of operator that's going to be successful.
So Dan, when we look at these companies though, and we look at their share prices, do these value people, are they getting rewarded any better than the growth folks right now?
No, I don't think so, right? Most of the sector, there's certainly a favoritism towards the larger companies in terms of the valuation multiples, right? Obviously, the integrateds have done much better with the integrated business model. Their DNA, as Reed said, is this return of capital to investors. So they've withheld. But even if you go down into the independents, you see the large E&Ps, which tend to have stronger balance sheets, who have made a little bit more of the adjustment in terms of return of capital to shareholders, trading at valuation multiples much higher than the small or mid-sized guys. On a cash flow basis, on average, the small and mid-sized guys are trading at 1.5 to 2 times crisis level cash flows. And again, that perception of crisis. Those are the valuations we've seen when oil was $30, not necessarily $50, $55, right? So, the value guys aren't getting that right now. And I think that's the question of, in the past cycles, it's been that commodity bull market that has led the acceleration of the commodities. And so we don't see that bull market in front of us in the near term. And so the value guys don't see the catalyst to close that valuation gap.
So Quinn, when you've done dozens of investor profiles, investor studies, what are the investors telling you? Do they see the value in these kinds of companies that are paying dividends, or are they still kind of wondering about the whole sector?
No, you certainly see the sentiment shifting toward dividend-paying stocks, and I think that's evident when you look at total shareholder return from the majors over the last 10 years and how their dividends have actually compensated for some of the returns being poor in their share price. What's interesting, and one of the things that I've heard from investors directly, is you do see this bifurcation of sentiment where you hear investors staying away from the independents in the Permian Basin, but then you hear the CEOs of majors saying that the Permian's where they're at. It's where they should be, and investors eating that up from the majors. Right. And I think that is where it gets down to the distinguishment of capital efficiency, balance sheet strength, and also track record of capital allocation that generates returns.
So it's that execution. So when we kind of think about a lot of the problem then is maybe about companies not delivering on these sort of some of the promises. What are some of the other things when you look at the preferences you mentioned earlier? We've gone beyond the sort of traditional operating things. So now we have a world that's thinking about greenhouse gas emissions, methane emissions. What are the investors telling you around that? Well, there's a lot of noise in the popular press about that. Is that something that's really taken over? Not just our industry of energy, but what do you see as energy versus others? Is it a more or less, or?
Yeah, I think that the rise in considerations about climate change and the environment have been reflected in the investing community as well. Over the last decade, you'll see that equity assets managed with an ESG theme have actually tripled over the last 10 years. Over that same period, the amount of those funds invested in energy has gone somewhere from 12% to 5%. So you're really seeing a decline in the interest of these ESG investors, within the energy sector. What's interesting is that, when we go out and talk to investors about what the core investor concern is as it relates to climate change in the energy sector, it's not about stranded assets or peak demand as you would think. It's actually more about societal pressure and the impact that plays on regulatory uncertainty. Right. I think we're seeing that unfold with the 2020 presidential elections and how much uncertainty that's causing. But I think it's important for companies to be aware of that and also start to shift their narratives to incorporate, some element of climate change, environmental awareness, and the realization that not only is it great to be a contribution to society and have a lower emissions profile, but also to ensure that benefits your strategy and makes you a better company at the end of the day.
Yeah, that just to add to that, that's one of the things that seems so interesting to me about this, because I deal with investors for most of the time, and I see these concerns, and what's interesting is that the energy transition is not here. Okay, it's all in the future. All right, it's relatively incipient right now, and so it's funny because there's a disconnect really between the reality of the way the world uses energy right now. And frankly, like I say, the last 5 years have been the highest 5-year growth for oil in history. Okay, so consumers still buying, but at the same time, the rise and blossoming of concerns around this and the societal pressures are coming up. And in some ways, companies are trying to figure out how to deal with both of those, right? At the same time, I need to understand these are real concerns and they're valid. At the same time, what my consumers are actually demanding is another thing, right? And that's a difficult thing for them to do. And I just think that in the end, a lot of companies I think have been reluctant. But look, perception can become reality through policy, particularly, right? And will force a change potentially as we move down the road here. And so, better to be ready for it and proactive.
Yeah, and I'm sorry, but it's not just the companies, right? It's the capital providers too, right? A lot of the investment banks, particularly European-based investment banks, they're dealing with protesters outside their buildings, things like that, in terms of social pressure when they're investing in these energy projects or energy financing. So, it hasn't necessarily risen to a level of a primary concern, but it's certainly a secondary concern for them. And the feedback that we're hearing is that these investments or these financings are really going to have to be a high bar to justify that additional scrutiny that they're going to get in terms of public perception.
I mean, we went through the whole divestment argument for a while, right? When there were some students in colleges and making a lot of noise, but I think it all, as you say, Dan, it all goes back to shareholder return. I think you still need to keep in perspective. Raul, I want to go back to something you brought up, which is really, there's a lot of sort of misconceptions right now that the popular press is sort of putting out there around this whole system. One of them is a simple one that has to do with thinking about North America, and is this a Ponzi scheme, right? That nobody's making money, right? Yeah. Maybe you could, and Dan could kind of jump in here with Reed on what's the truth about that. It can't be nobody making money, right?
Well, it's interesting. To me, there's a, have you made money? Well, it depends on how you define making money, obviously. If you define making money as giving a consistent and strong return on capital, absolutely they have not. On the other hand, I would say that they have been involved in a growth phase. And in an industry that's this capital intensive, almost always, in almost any business, okay, Amazon has never made any money. Okay, why? Because their reinvestment is so high, and they're growing, but people have faith in those investments to return over time, and people have lost faith in this. But the U.S. has tripled oil production, right, and gas production's up massively. That took a lot of money to get. Okay, and so yeah, there wasn't a lot of returns. Now, at the same time, we can point to them. There are a lot of bad assets, a lot of bad investment, and so some of it is very, very true. Yeah, and some of it is a function of growth. I think it's both of them. Dan, what?
No, I think that's right. I mean, Ponzi scheme is kind of a buzzword, right? Gets a lot of attention. But at the end of these days, these guys have created real tangible assets, right? So we've taken production from, 5 million barrels a day in 2005 to 12 million barrels a day. So, and the reserve and all that growth that goes with it. So there are underlying, real tangible assets that and actually, if you look at the intrinsic value, they have created intrinsic value. The problem is that it's not getting reflected in stock prices today. Most of these companies are trading below their intrinsic value for the things that we've been discussing. But they've created real economic benefits, tangible assets that wouldn't apply to a Ponzi.
Yeah, our study shows $1 trillion worth of revenue, right? Yeah. So another one out there, Reed, is about the majors are taking over, right? The era of the independence is done. The majors are taking over. What do you think about that?
So I speak with a lot of operators, a lot of service sector, some investors, and one of the things that stuck out to me one time was a client said, I don't need 30 Permian stocks. I need like 7. I simply don't need that many options of equities I can buy. And when you think about it, how many material deep water operators are there? 7. So, at the emergence of a technology, you're going to see a lot of people, you're going to see a lot of companies trying a lot of different things. And to Dan's point, that's largely what led to 5 million to 12 million barrels a day. But we're hitting this maturation point in the industry, in the cycle. And so the majors are going to come in and play a more material role. But I think that there's still enough, the landscape in U.S. unconventionals is still unique enough that we're not going to see the consolidation in the next decade like we've seen happen in different technologies or different asset bases. Yes, our belief very strongly is the majors are going to deliver on their commitments out of the Permian Basin. But you're still going to have 25, 30 operators out there. Over time, we'll see more M&A as companies join to add that scale materiality for all the reasons we've talked about. But they still hold a very, very critical role in that, look, if you want to advance the industry at a rapid pace, it takes people willing to risk capital. And that's not what the majors want to do, which is why we didn't see them really enter unconventionals for so many years. It wasn't Exxon that went and de-risked the major plays. They waited until there was some certainty and the risk had already been borne by companies that we no longer talk about. So we do see consolidation, fully expecting the majors will play a larger role in U.S. supply. But there is still very much a role for the independents. What the independent operator looks like, I think we're going to see that management style and that operational style transition more towards a major than a major transitioning to an independent. But there is definitely still a role for U.S. independents.
So it's sort of you get them to 3 million, but that's 3 million out of what, right? 14.
Yep.
Still pretty small.
Yeah.
So one thing that maybe we should try to think of, we kind of diagnose the patient here, so to speak. What can we do to kind of recommend or things that we think that might happen that for these independents and for the companies now in the U.S. to bring investors back? Maybe this is a good way to, maybe we'll start on this side with Quinn, since you represent the investors today. These guys are going to make you a little pitch of, try to get you back to give them some more money. And we're talking, what, a considerable amount, right? I think $100 billion a year sort of number. So what sort of things are the investors looking for? What are the top 5 or top 3?
I think first is capital strategy and really efficient, disciplined capital strategy. Second of which, I want to bring up a statistic here is that 67 or 70% of the people that we speak with believe that the energy sector is undervalued and believe that there is a cyclical rotation that could be coming back into the space. A lot of that is going to be dependent on macro factors. So, macro certainty, global trade tensions easing, a tighter supply-demand dynamic. But a lot of that also sits with, I think, the company itself and what these corporates are doing. Now, on the ESG side, it's about recognizing the need to invest in technologies for the future, but also putting a rhetoric out there that says that fossil fuels are not going away. There's going to be continued global demand. It's about positioning your company within that transition, whether it's a multi-decade, multi-year transition, and being prepared for that from an organizational perspective, I think is what's going to draw at least investor interest back into the space. And then getting them to even take a look at those stories and deciding if they want to commit capital, I think is the second step.
Do we have any other industries that have had a similar problem? You could draw on to provide an example.
I've heard of the energy space being compared to the likes of coal or big tobacco in the past. So those are not great industry comparisons. But I would say that it is facing a similar crisis. But I do think that there's enough data out there on the current energy transition and what it's going to take for companies to be able to defend themselves against some of this societal pressure out there.
Oh, what are three things that you would recommend that companies need to do that might add to the...
Yeah, well, I think you need a credible plan. And first of all, you could help yourself a lot on your own greenhouse gas emissions, and particularly methane. Honestly, it's a problem that has solutions. Okay, and there's other things you can do to reduce your footprint. That's easy. But honestly, to bring back the general investor, I think you just need to deliver consistently enough money that they can stop ignoring. It's like you say, it's easy for them to ignore it. Well, you're not making any money, and I'm worried about your future, right? Mm-hmm. And you continue to not be disciplined about this thing. So why would I even bother, right? They'll start to notice if you start to deliver high rates of return, right? Mm-hmm. That could be a ways away because, of course, everybody's in the prisoner's dilemma where everybody wants the other people to be restrained. I wish you guys would restrain yourself for a little while I go through the door ahead of you. Because, right now it's the Three Stooges trying to go through the door and they're not fitting, right? So anyway, I think deliver consistently for a while to build up that track record and regain the confidence. It's going to be a while. And it's going to be difficult. And frankly, there's going to be a separation of the wheat from the chaff, and to some degree.
So when you mean a while, are we talking 3 years or 5 years?
Yeah, I don't think it has to be 5 years, but you got to deliver pretty consistently across the cycle for 8 or 12 quarters. Yeah.
Yeah.
What do you think is going to bring it back?
Well, I'm going to largely agree with Raul. Investors have now pivoted to wanting returns, and I think that the U.S. has done a good job of that this year. You look at the growth in 2019 so far, it's been almost zero. I mean, it's almost a rounding error. What we saw in 2018 was price went up, supply went up. In 2019, prices wavered a little bit, some ups, some downs, but they've stuck with their plan. So I think that we are at the start, maybe in the third inning, of showing that they are committed to this new expectation that investors have. But again, it's the third inning.
And they've shown the discipline, but the money hasn't shown up yet.
Right. So I think that, in the next 18, 24 months, if we can continue down this path, then we'll start to see perhaps a rekindled love story between the two, or at least less ice between the two. But again, I think it's just it's a downtime for the industry. We're just going to have to wait this out and stick to, as we've heard, come up with your plan, sell it to the market, stick to it.
So it's execution. So Dan, if you go to many investor shows, they're packed, right, with companies making their pitch, and there's a fair amount of investors there. Yeah. So what do you hear that's differentiating these companies?
Well, not as packed as it used to be, I would say, first of all. But I think first, companies have made fundamental change, right? In certain areas. If we look at, we did a study looking at the executive comp plans of North American independents, and we see some real change there, right? So in 2015, 2016, something more, companies like over 70% of companies had volume growth as their number one incentive in terms of executive compensation bonus pool, right? Today, that's less than 30%. So we've seen the shift. And then it's flipped. So now we see, more than 2/3 of the companies have return as the primary objective in terms of that executive comp plan. So I do think, the companies have made some fundamental changes. I think you probably should also start including things like, free cash flow yield, free cash flow analysis, because that's a big focus among investors today. And then I think just generally speaking, actually Quinn's group did an interesting study where they rank the I guess the management teams and investor relations of these different industries, right? And we saw really from 2017 to 2018, the management investor relations ranking for energy plummeted. And was way off the scale compared to the other sectors. So, there was a real distrust, I think, in terms of the belief, the faith that they have in management teams from 17 to 18. And like any relationship, it's going to take time to rebuild that trust. So I think Rahul's right. It's going to take maybe, kind of 4 to 8 quarters of consistent performance, continuing to deliver on its capital discipline, and probably need to get returns back into the double digits. So we see all the cost-cutting efficiencies, return on capital employed is now back into the high single digits, which is what we saw pre-2014. If you can get that into the double-digit range, I think then you start to get some more attention.
So one last thing I want to kind of quickly hit is maybe a little bit of a misconception too. Is there any money out here for these guys, or is it all dried up?
It is mostly dried up. But actually, if you have very high quality assets and you're looking to just maybe rotate debt, you can get that done. In general, the bond markets are a little bit more generous, okay, than the equity markets, I think.
The other thing I'll say too is we talk all this capital discipline and restraint. I mean, the one company that kind of stands out in terms of share price performance has been Hess. And Hess is spending in Guyana. They're spending, so they're actually outspending cash flow. So it always gets back to, Wall Street loves a good story. There's not a lot of Guyanas out there, but if you have a good story, even if you're not fitting into all these things we're talking about, you can still find,
I think it's also important to note that when we speak to investors, they mainly go back to the point of it is my fiduciary duty to provide the best returns for my investors. Yeah. So it's not all about climate change and doing better for the environment. So I think that goes back to your point about if you have a good story, if you're providing returns and improving those returns to investors, eventually you're going to get the interest of the capital.
And maybe that's a good place to lead up to kind of finish here today with Quinn very aptly said, it's still all about shareholder returns and it's all about the money. So thank you very much, Quinn, Rahul, Reed, and Dan for providing some insights today on sort of what's happening in the story of North American independence and really global independence in the E&P business as they try to bring investors back.